There's a reason the story of WeWork still fascinates serious business and history enthusiasts. It's not just about a startup that failed. It's about how charisma, cheap money, and unchecked ambition combined to erase over $11 billion in value in spectacular fashion. This isn't a tale of bad luck. It's a case study in decisions, incentives, and blind spots that you can actually learn from. If you pay attention, you'll start to recognize the same patterns showing up again in newer companies today. Let's get into what really happened, and more importantly, how to think about it. The rise of WeWork was built on vision more than fundamentals. WeWork didn't start as a fraud. At its core, it was a simple business. Lease office space long-term, redesign it into trendy co-working environments, and rent it out short-term at a markup. The idea resonated in a post-2008 world where flexibility became valuable. What transformed it into something far bigger was the narrative crafted by its co-founder, Adam Neumann. He didn't sell office space, he sold community, lifestyle, even spirituality. Investors weren't just buying into a company, they were buying into a movement. This matters because storytelling can inflate valuation far beyond reality. WeWork was valued like a tech company, even though it was fundamentally a real estate operation with thin margins and heavy liabilities. A practical takeaway here is simple. Whenever you evaluate a business, whether investing or starting one, strip away the narrative and ask what the company actually does to make money. If the story sounds bigger than the revenue model, you're already looking at risk. Cheap money and aggressive expansion accelerated the burn. The real fuel behind WeWork's growth was capital, especially from SoftBank and its Vision Fund. With billions pouring in, WeWork expanded aggressively across cities worldwide, signing long-term leases at a pace that far outstripped demand. Here's where the structural flaw became dangerous. WeWork had fixed costs, long leases, but flexible revenue, short-term tenants. In a downturn or even a slowdown, that mismatch becomes lethal. The company wasn't just growing, it was scaling risk. You can apply this thinking directly in your own decisions. Whether you're running a business or managing personal finances, avoid locking yourself into long-term obligations based on short-term income assumptions. For example, taking on a large loan because your current income is strong but not stable mirrors exactly the kind of mismatch that hurt WeWork. Corporate governance failures made things worse. WeWork's downfall wasn't just financial, it was managerial. Adam Neumann maintained extraordinary control over the company, even as it took on massive external investment. He engaged in controversial practices like leasing properties he personally owned back to WeWork and selling the trademark We to the company. These weren't minor issues. They reflected a lack of oversight and accountability at the highest level. Strong companies build systems that prevent founders from making unchecked decisions, no matter how visionary they are. When governance is weak, even a good idea can spiral into chaos. For viewers interested in applying this lesson, it's worth looking at how decision-making works in any organization you're part of. If one person has too much unchecked authority, risks tend to accumulate silently until they explode. The failed IPO exposed the reality behind the hype. The turning point came in 2019 when WeWork filed for an IPO. For the first time, the company had to open its books to public scrutiny. What investors saw was, well, alarming massive losses, questionable governance, and a business model that didn't justify its $47 billion valuation. The public markets reacted immediately. Confidence collapsed. The IPO was pulled, and WeWork's valuation plummeted. This moment highlights a critical truth. Private markets can sustain inflated valuations longer than public ones because scrutiny is limited. Transparency changes everything. If you're analyzing companies or even side projects, this translates into one habit. Test your assumptions early under realistic conditions. For instance, if you're launching a product, try selling it at scale before assuming it will succeed. Exposure to real scrutiny is often where weaknesses surface. Leadership instability accelerated the collapse. Following the IPO disaster, Adam Neumann was forced out. Leadership turmoil followed, layoffs began, and the company entered survival mode. SoftBank stepped in with a bailout, but by then, billions in value had already evaporated. Leadership transitions are always risky, but in WeWork's case, the entire company had been built around one personality. Once that figure was removed, the structure struggled to hold. The lesson here is about building systems, not personalities. Whether in business or personal projects, sustainability depends on processes that can function without a single individual at the center. What burning $11 billion really means. When people say WeWork burned $11 billion, it's not just cash disappearing overnight. It's a combination of investor losses, inflated valuations collapsing, and capital being deployed into a model that couldn't deliver sustainable returns. This distinction matters because it changes how you think about risk. Losses often happen long before they're visible. They're embedded in decisions that haven't yet been tested. A practical way to apply this is to track not just outcomes, but assumptions. If your plan depends on perfect conditions to succeed, the risk is already present, even if things look fine today. Why the WeWork story still matters today. WeWork isn't just a historical curiosity. The same ingredients, charismatic founders, abundant capital, and narrative-driven valuations continue to appear in cycles across industries. What makes this story valuable is that it teaches pattern recognition. When you see rapid expansion without clear profitability, complex structures masking simple businesses, or leadership operating without oversight, you're likely looking at a similar setup. Understanding this doesn't just make you a better investor or entrepreneur. It makes you a sharper observer of how modern economies actually function. If you found this breakdown useful and want more deep dives into financial history, corporate collapses and the lessons behind them, make sure to subscribe and share this with someone who takes business seriously.